I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to the first September installment of 2022's What We Learned in the Markets This Week video. As my coworker so graciously reminded me this week, it's the first week you can get pumpkin at Starbucks, so that's got to be the kickoff to fall, right? Now remember, our aim is to provide you, our valued clients, with a brief video giving you information that's helpful to your understanding of what happened in the markets this last week, while also drowning out the agenda of the news media in America. So the four things that we learned in the markets this week, let's go into number one, and it's same story, different week. The major averages fell for a third straight week in a row after gathering a lot of steam during the morning session Friday. We got a really solid jobs report, which saw the U.S. add 315,000 new jobs for the month. The unemployment rate rose to 3.7 from 3.5, but this was directly attributed to the fact that we had more workers coming back into the workforce, which is a good thing. That's what you want to see. Considering the stock market was so strong during the Trump years and during Biden's first year, it's no surprise that during our first bear market outside of COVID, of course COVID's was only a few months, has pushed many retired clients back into the workforce. And that's what we saw in the data as their asset levels have decreased. For the week, the Dow dropped 3%, the S&P 500 lost 3.3%, and the tech-heavy NASDAQ, your growth funds, saw a decline of 4.2% for the week. Point number two, in honor of our first weekly Whitaker-Myers Wealth Managers Client Question of the Week, which you can go check that video out if you want on our YouTube page, I'm going to provide some comparison to our current economic environment and recent history to hopefully prove to you, while the market is acting up currently, we are not anywhere near an extreme economic shock, historically speaking. So let's ask these questions, and you can pause the video if you want a second to think about them and see if you can answer them right. Question number one, when did the U.S. hit peak unemployment from 1948 through 2019? Perhaps your mind, like mine did, goes to the Great Recession of 2008. Or did you know that in October of 2010, we hit 10% unemployment? Yikes. The correct answer, though, however, was November and December of 1982, where we hit 10.8% in both months. Question number two, when did annual U.S. food inflation hit its high over that same time period, 1948 through 2019? CPI food inflation actually hit its World War II peak in December of 1973 at 20%. In April of 1980, it was 7. Okay. Question number three, S&P 500 corporate operating earnings have only posted one negative quarter in the last 30 years. Do you remember when it was? Perhaps a sudden economic wartime shock made it happen, like 1990 when Iraq surprised us all with the invasion of Kuwait. Or maybe it was 2001, 9/11 and the tech bubble. The correct answer actually is quarter four of 2008. And even then it was barely negative, 0.09 cents a share negative operating earnings. Think about that for a minute. An economy that has been through everything we've been through over the past 30 years, and it's only posted one negative quarter in the last 30. And you, my friend, are blessed enough to get the chance to invest in that economy once you get to baby step 4. Point number three. You may have remembered in previous installments of our videos, I talked about data from our friends at DataTrek. They're wonderful. They looked at the number of 1% moves daily, meaning the market went up greater than 1% or went down more than 1% as a measure of peak volatility based on historical measures. Now here are the basics. Here's the things you need to know. Over the long run, the S&P 500 averages 13 1% moves during a quarter, during a 3-month period. When it experiences 33% or 33 or more 1% moves, then we're in extremely choppy water and it's close to peak volatility based on historical measures, meaning it should get better from here. This year, we've gotten close to that 33 level. We had 32 1% days in quarter one. We had 31 1% days in quarter two. And so far in quarter three, with today's movement, Friday today, 18 1% days. We'll therefore need to see 15 more 1% days. And remember, this is up or down. And there are 19 more trading days left in this month. So we'll continue to watch this and track this trend very closely to see if we're close to hitting peak volatility based on this measure. And point number 4, jobs, 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 jobs. That's all we talk about. There are roughly 11 million jobs open right now. Why is that? Well, there's a lot of reasons. Partly, mainly, one of them is government assistance created massive amounts of cash in our system, allowing those who normally would be forced to work to be able to stay at home and sit this out during COVID. But here was a piece of data that was fascinating to me this week when I was reviewing it. The U.S. Department of State released immigration numbers relative to work immigration. If we can't hire enough workers or find specific kinds of workers, what we tend to do is bring them in from other countries. And let me tell you, friends, that is a beautiful thing to allow others who have a desired skill, trait, or work ethic into our wonderful land. And how it works is like this. If a multinational company, a company that's in multiple countries, let's use Boeing, for example, they want to transfer a foreign worker into the U.S., it applies for an L1 visa. In 2019, we issued 76,988 L1 visas, along with 80,720 L2 visas. And those L2s allow the individual spouse and dependents to come to the U.S. with them while they're working. In 2021, the number of L1 visas plunged to only 24,863. If you're doing the math with me there, that's a 68% drop. Meaning, if we could fix our broken immigration system, we could put a major dent in our labor shortage. I remember as a young advisor reading a research piece it's still stuck to me to this day. The title of that research piece was Demographics Equal Destiny. And our chief investment officer at the time reminded us to keep our great country thriving, we must reproduce, have babies at a higher level, and find a way to bring the best, the brightest, and the hardest working to our great land. And when's a better time to do that when we have 11 million jobs opening? This is why, as a faith-based organization, we are so paramount that the family's important. Mom and dad, and creating that family that creates reproduction that basically helps the economy. Also a legal immigration system. So those are 4 amazing things that we thought we learned in the markets this week. Hopefully that was helpful to you. If you have any specific questions about your particular situation and how the markets are maybe changing those, please reach out to our advisor. In the notes, you'll see a link to our website to schedule a meeting. You'll also see in the notes a link to our blog where you can read a ton of the great articles that we've written this week. We thank you so much for your continued trust in our firm, and we'll see you next week.